as you know, we're going to be talking about the rise and fall of retail investors. So let me just emphasize why our panelists today are the best people to be talking about this. June, as we know, is of course the global CEO of IEG Group, which is the world's leading provider for CFD trading and also a platform that allows clients access to 19,000 financial markets globally. Lule is US CEO of eToro, which is a social trading platform and features more than 3,000 assets and 30 million users. And of course, Victoria, head of investment at Interactive Investor, which is the UK's biggest flat fee investing platform. So stellar panelists today, hopefully a stellar panel as well. So I'm going to begin with a question for all of you that I'm also going to be asking our audience. So this is my poll question for today, if we want to bring that up, which is basically, what is the biggest challenge that you think retail investors will face heading into 2023? It's a big year, it's a difficult year after an already difficult previous year. So what are your thoughts? June, let's start with you.
Yeah, so I think one of the biggest challenges is trying to figure out how to navigate, get the right information that it gives them the insights to diversify their platform. As was said earlier, we basically have 19,000 markets, which include gold, commodities, oil. So being able to pivot in this market is vitally important, and getting the information that allows them to make that possible and understand their risks is what we do.
All right, and Lule, what about you?
I think, last year was the shock and awe year for a lot of retail investors. So our platform has primarily millennial and young Xer investors, and it's a social platform, and so there's dialogue that happens on our platform, and it wasn't a generation that had seen this depth of a transition, so it's a shock and awe year. I think the challenge now is just steeling themselves to understanding, as that medicine makes itself through the system, its side effects, right? We just saw recently, part of it was interest rates and how banks balance their balance sheets because of that. And so I think just having the resiliency, the continued resiliency they've already shown to see the medicine as it works its way through both our economy and our politics.
And Victoria, what about you?
I think during the pandemic, there was almost a sense of euphoria with this huge market rebound. And then after Pfizer Day, that continued to push markets higher. We had the tech boom, which propelled a lot of asset prices to record highs. And now we're entering into this age of uncertainty. There are so many different factors to navigate, from the war in Ukraine to rising inflation, and now, of course, the potential for a banking crisis as well. And I think on top of that, there's the added complication that cash is a lot less attractive now because of the inflation backdrop, which essentially means you're losing if you're not investing. So that can add to pressure on investors to try to find solutions. So I think it's essentially navigating all of these different competing pressures.
All right, well, let's pull up the poll results now and see what our viewers are thinking. What is the biggest challenge? Looks like it's a bit of a tie, actually, between picking recession-proof assets and getting inflation right. So it seems like inflation, recession, certainly big themes for 2023, and there's a lot of tension over what's going to win out over there, what's going to be the dominant theme. So, all right, well, Victoria, let's move on to you then and kind of dig more into some of the things that you've observed this year. Again, as you mentioned, it's a challenging year, already a challenging year previously, and even more so, it's unprecedented times for retail investors. What has been one or two trends that you've noticed emerging in terms of investing styles or preferences at the moment?
Yeah, well, when times are tough, we tend to see that investors move away from active funds towards more passive investments, and that's certainly been something that we've seen this year. We've also been seeing our investors move more towards global assets, so looking beyond the UK borders, particularly towards the US, actually. That's in terms of investment trusts and funds. Then on the single stock side, we continue to see the FTSE 100 dominate. We are a UK platform, and FTSE heavyweights like Lloyds and Barclays and BP and Shell are continuing to be among the most popular stocks on our platform. There was an interesting outlier, which was Argo blockchain, which has made it into our top bought list in the last 2 months. And that's essentially because it's a proxy play on the crypto rebound this year. Obviously, Bitcoin has been has done extremely well amid the backdrop of volatility. And whilst you can't trade crypto on our platform, you can trade stocks that are linked to crypto. So Argo Blockchain is one, Coinbase is another one. So yeah, quite a diverse mix. But sort of more of a broad geographical spread, and then that shift towards more passive investment products like ETFs, for example.
Yeah, June, I saw you nodding a lot in agreement when Victoria was mentioning just diversifying assets. I know you're a big fan of this investing thesis, classic thesis, but maybe not something that retail investors see as important. But how important has it become now? And do you think retail investors are realizing this more?
Yes, the evidence in our platform, and you have to think about who our clients are. Our clients are usually very active traders and investors. They're quite sophisticated, whether it's on the Tasty Trade platform in the United States. They're moving from options into futures. And not only are they active equity investors, they're trading options as well as futures. And there we see on that particular platform that they're moving more away from single stocks into more index-linked opportunities, as well as looking globally, where we operate in about 21 countries. What we're seeing there, because the breadth of what our traders can take advantage of, we also see movements into gold, we see movements into oil, taking advantage of the fact that oil is priced at like $69.50 this morning. So there is volatility in the market. They're very confident individuals, so they move across asset classes very nimbly. And that is kind of the key right now, is to stay light on your feet, because no one can predict the peak of the interest rates. So having the ability to pivot quickly is part of the challenge.
All right. Well, now I want to pull up the Markets Today platform, because we're very much talking about anything that markets are buzzing about today in the last few days. And I know that, of course, it's going to be all about this mini banking crisis that we're facing, and really the question over what policymakers should prioritize. Is it financial stability, or is it really tackling that inflation issue? Lule, we've seen really quite a lot of turmoil in markets over the last week or so with the downfall of Credit Suisse and, of course, the 3 U.S. banks. What do you think this has done in terms of investors' faith in traditional institutions, especially investors who are just your everyday people? They're not experts or anything.
It's interesting because we have the benefit of both serving our investors every quarter, but we also see their behavior in terms of what they buy and sell and hold. And so the vantage point of our customer base is, as I said, it's a younger, longer time horizon customer base. We have over 30 million sort of followers in our system. We have crypto, stocks, options on our platform in the US. And so there's an element of sort of like above all of the above that they're doing. So the one thing you do see is they're not getting scared. So still 67% still say they're going to hold most of their assets. They're not going to sell on the low. But the other thing they're doing is when you see their behavior, so the day the bank crisis started peeking its head, you saw options activity rise, crypto rise. I mean, just for perspective on your crypto point, year to date, Bitcoin, I think, is up 67%. Right? So again, I think what's happening is gone are the days where people are thinking to themselves, save me, Papa or Mama, I'm going this way or the other. They're just saying it's both about institutions doing their part and maturing a decentralized system. It's all of the above.
Yeah.
It's both about investing for the long run when it comes to diversified instruments like ETFs, perhaps, as well as engaging in options which allow you to shorten your durations, reduce your risk, but take opportunity in different market environments. So there's this ambidextrous nature that's happening even in unsophisticated investor markets. So for instance, in our space, even individuals who say, I'm newer to investing, have a higher appetite for risk. So it's a very different dynamic than when I was an executive in 2008, for example, where people were really sort of sheltering themselves. And I think that the resiliency of sort of making sure that they're keeping cash on the side because they want to be opportunistic, but doing this sort of, as I said, this ambidextrous sort of diversify and anchor, opportunity, opportunity, opportunity. It's coming. We're seeing it in their behavior as well as in their surveys.
Yeah. But of course, the adoption of these less traditional assets and markets very much tied with the regulation, right? That has been allowing, well, investors to kind of setting the parameters of what they can or can't do at the moment in the space. June, I know you have some thoughts on this. What do you think about the amount of regulation that we're seeing now in markets in general, really, but perhaps also in less traditional markets? And do you think it's enough? Do you think it's too much? What are your thoughts?
Well, I think it's a very broad question, because if you look at by asset class, currently, obviously, crypto is under the scrutiny in terms of not just the U.S., but on a global basis, to figure out what's the proportionate level of regulation necessary. Markets like in Japan, it's perfectly possible. Switzerland, the same. The U.S. is taking a harder look. So it's going to be market by market. I think that each regulator is going to take a stance on that. What we're seeing in the United States in general, historically, has always been a market-friendly environment in terms of regulation, which has created the largest financial market in the world, and that actually has enabled retail investors to really participate. I think what is interesting is that that's also being looked at on a European basis to see to what extent there could be new regulations that encourage retail investors, whether that's the Edinburgh reform that's just been announced. Those are all stimulating, or actually asking the question of how you create broader financial markets. So clearly after 2008, huge onslaught of regulation. All of us have, in financial services, have experienced that. The question is what's proportionate. And I think countries are looking at, on an individual basis, what's going to make them the most viable place for retail investors to thrive. Fundamentally, defined benefit programs are, diminishing, being demolished on a global basis. And as a result, that's why retail investors are becoming much more self-directed, even in low market activity, like we saw last year, relatively speaking. We saw a 50% increase in all the content that we create for our clients, because there's a hunger and an interest in taking control of your own financial destiny.
All right. Well, you all have touched on kind of just the growth of the retail investor base, both in terms of the numbers, but also in terms of the level of sophistication that we've seen, right? And I want to touch on this idea of this traditional divide between the so-called smart money investors, which a lot of you in the audience are at the moment, and what retail investors have been termed as the dumb money. So, Victoria, do you think this gap still exists? How much is that closed? And what do you think has contributed to that narrowing gap, if it has narrowed?
Yeah, I think this gap has massively narrowed. There's been a huge onslaught of available information online. There's so many resources out there to help with financial education. Apps like Interactive Investor and IG and eToro are very, very easy to use, investor friendly, and it's become cheaper to invest as well. So we've really been focusing on trying to democratize finance and provide access to more and more retail investors. We've also got certain rated lists like our Super 60 and Ace 40 lists, which can kind of guide you towards different investment products, spark different ideas, and kind of get you on the right track. I think there is one area where retail investors are still sort of get the sloppy seconds, which is IPOs, and that's something that we've been doing a lot of lobbying on. There's the digitization task force that's coming out in spring. It's been looking at ways to try to get more retail investors access to IPOs. This is still an area where retail investors don't have equal access. So I think the gap has been narrowing very significantly, but there are still some gaps to plug.
Okay. Now, June and Lule, I'm curious, for your respective platforms, what sort of specific ways have you seen investors try to raise the level of sophistication in their investing? Maybe Lule, we can start with you.
So several ways. So one is, as I said, they're partaking in pretty sophisticated instruments like options in understanding how to hedge their bets, how to take advantage of volatility and implied and so I think those things are definitely, we're seeing it, and we're seeing an adoption of that. And just for context, I think options contracts reached their highest levels the week of the bank crisis, and investors that were in retail were a big part of that, right? So we're seeing adoption of instruments that require more sophistication to partake in, but also they're appreciating that it is not this absolute of risk and non-risk. It's about how do you dimensionalize the risk? How do you make it smaller and frequent, right? Which is the whole thesis of becoming more resilient to risk, right? So we're definitely seeing that. We have not seen them, seen them hold their crypto for the most part. And as I said, when they see volatility, when they see opportunity coming into it, and then they're holding these traditional asset classes like equities and ETFs. I would say, our platform is essentially, social investing and the wisdom of the crowd on our platform is the feature, not the bug, right? And so ultimately what happens is people are coming to these town squares to share interesting insights. There are what we call popular investors that people track. And one of our popular investors has over 1 million followers on our platform, for example. So we have mechanisms for people to copy strategies if they want to. But then we also put mitigants like making sure that there are risk mitigants around this structure, right? And so what's happening, in my opinion, whether it's fractional shares, which we have on our platform, or different kinds of instruments in a multi-asset platform, what's happening is access, lower costs, they're commission-free, that is, right? And then the proliferation of the voice, if you will, the wisdom of the crowd. I think, you were saying dumb money. I want to put a T-shirt that says dumb money because dumb money is the other way around now. And I think that, you can't look at history through the point in time that you're living in. You have to look at it through the secular trends you're living through. And that secular trend is not going to change. Decentralization is here to stay. And the access of individuals to institutional things that were not available to them is going to continue. And I think those are secular trends that will take place again, and will have momentum once we get past this environment that we're in.
Yeah. What about you, June?
Yeah, well, I would agree as well, but in terms of playing a role in terms of democratizing investing from institutional to retail, we specifically offer institutional quality risk analytic tools to our active traders, to our clients overall. So whether it's on the Tasty Trade platform, we have leading edge technologies in order for them to understand their portfolios and also understand their risks on option strategies, and very complex ones as well as simple ones. We create boot camps for people so that they actually get the chance to learn from experts. I mean, most of our people that are actually engaging with clients in terms of answering questions have over 20 years of experience in options trading. So you have experts that have really faced all sorts of fires over time and can provide perspectives and insights on what's happening in the market. We have 7 days a week live programming on activities in the market so that people can hear what's possible and take their own view on that. As well as in our OTC derivatives platform, we provide risk analytics tools so you understand your win-loss ratio, you understand your P&L, you actually understand how your trading patterns and trading practices actually are putting you in a good or bad position. So we're taking a lot of the institutional know-how created by many of the people that created the company and also are in the company, and making that accessible and understandable by retail investors across the globe.
Yeah, well, all of you very much touched on the importance of information, right, and having access to it, democratizing it. So this brings us very nicely to another topic that's very relevant for retail investors, which is, of course, again, finding that information and arming themselves with as much knowledge as possible so they can trade in the best way that they can. And it's very interesting because this has been a space where, June, as you mentioned, traditionally has been dominated by more established players, right? Like institutions that do offer that access even to retail investors. But I think more recently, we've also seen the rise of social media influencers, some of them very dubious, but very popular still, and offering maybe questionable advice on what to do on your own trading platform. So, I mean, Victoria, I know that you're looking at this trend. You're very much kind of a fan of encouraging people to think long term. How do you think this kind of noise that has emerged from social media complicates things?
Yeah, well, I think obviously social media is incredibly important, and there is amazing information out there. You can follow professional investors. There are so many different companies or resources of information that are out there on social media. So we certainly can't disregard social media is the first thing. It is the future. But there are a lot of, like you say, dubious accounts on social media. A lot of kind of get-rich-quick schemes and lots of things that look too good to be true. So I think it's really important to proceed with caution and always do your due diligence. Don't kind of follow someone blindly into a trade recommendation. I mean, you should never really do that anyway. You should always be doing your own research on top of following other people and seeing what everyone else is doing. The FCA has been looking into this and potential regulation. It's already been clamping down on some buy now, pay later services, and we know that they're keeping an eye on investment advice on social media because at the moment you don't have to be a actual official advisor to be putting out videos there which are not going to be necessarily accurate. So I think the regulatory environment is going to evolve over time, something that the regulator in the UK is already looking at. But there's no point kind of disregarding social media altogether. It's just you need to be a bit cautious when you're navigating the world of social media. Like, not just in finance, but in any form of social media, there's kind of the good side and the bad side. So as long as you're kind of mindful going into it and don't be too swayed by one person's opinion when you don't necessarily know if they have a good reputation. So yeah.
Yeah, June, I know you have thoughts on this as well. Pros and cons? Should they avoid it altogether?
Well, no. You can't avoid social media. I think it's important that, the good news about it is it actually has created a lot of interest from people and made, investing a topic that, millions of people talk about and are interested and engaged in the market. So I think there's a positive to, again, people having to take responsibility for their own financial future. So that is excellent. I think also what's encouraging is that increasingly there are people in the investment industry at different levels have actually sought that channel and promoted their voice through it. So the responsible players that are in it can be wildly influential and highly important to helping people navigate and improve their understanding of markets. But to the same point that Victoria said, it can't be the only thing. It can't be a diet of only social media. Social media by itself, without some of the discipline and rigorous analysis on your own, really can make sure that people fall afoul. We heard that in previous panels. A lot of independent analysis is needed. What we see from our clients is that they actually ingest lots of different media. They spend 2.5+ hours a day really studying markets, trying to understand through all sorts of channels, Bloomberg, ourselves, any kind of publication. They're not just tuning into Twitter and or the social media platform, and they are discriminating as to who they actually put credence on. So I think used appropriately can be very, very powerful. It can also be very timely, and in rapidly moving markets, that can be a good, very, very valuable.
Can I add to that as well?
Absolutely.
So one of the reasons we felt so strongly about bringing it back into our walls and not letting it be the wilderness people have to navigate is then you can actually then figure out how to manage the moral hazards, right? Which is what we're talking about here. So for instance, on our platform, in order to partake, you have to show your strategy and your holdings. Not personal information about yourself, but you cannot easily, somebody will easily be able to audit what you say, what you're holding, right? The other thing is you have to be a public figure on our platform. You have to actually be, on a public setting to be able to partake. So there's certain things that I think when you put these sort of guardrails around, you get the best of this element and you guard against the moral hazards of it. And there are plenty of moral hazards to guard. I do think, though, figuring out how research, the way we have our research on our platform, the way you invest, and then figuring out how to turn that into dialogue is something people hunger for. Our surveys show us 80% of them want to be able to see other people's strategies and copy it. 70% of them want to be able to have dialogue in this public square. So they're hungering for it. So I think it's our responsibility to figure out how do we manage the moral hazards while untapping its powers.
Yeah, well, a follow-up to you then, Lule, because I know there's also this, and we've talked about the importance of guardrails and really protecting investors on your platform so they don't stray from more questionable sources of information. But what about the entertainment value of the information that you provide? Is that something that has kind of increased in terms of the importance to get the message through to investors?
Yeah. I mean, I don't know if anybody has kids in this room, but there's nothing I can teach my children without making the education more entertaining. I don't think just because we become adults, suddenly we want to be bored when we learn. So we do employ elements of joy and fun in the education elements of it. And a lot of our folks who are in our content and creation team are actually very right-brain thinkers. It's actually really important to make sure that you have right-brain thinkers on your staff who are thinking through how does a message get through. And so I do think it's important to make it palatable and interesting, and not necessarily to trap people, but because you want to make sure that the lesson is heard. So I joyously embrace it.
Great. Well, all right, so we have some questions from the audience, actually. So this would be a good time for us to talk about this. Interesting questions you can see here. A question about the gender mix of your various investor bases and talking about how to encourage more female participation. We were talking about this in the green rooms. I know all of you have thoughts. Drew, maybe we can start with you.
Yeah, so in terms of our investor base, sadly, it's not as diverse or as proportionate as we would like. So we're talking about maybe 20% of all of our clients are women. And what we see is in Asia, that's a higher percentage than in Europe and even in the United States. So what's interesting about that is that there's lots of headroom, lots of upside in terms of women getting involved, getting interested, because 50% of the population still need to take care of themselves and have to have a viable strategy in order to have retirement and have what I call financial freedom. And just putting your money in the bank is not going to get you there. So I think there's a huge amount of upside. In terms of encouraging women to participate, I think the fact that we're all women shows that women aren't afraid of investing and trading, and they have the analytics and the capabilities to learn just like everybody else. Sometimes it's a question of confidence, and confidence, as we heard in an earlier panel, really does affect the financial markets. So confidence as individuals to feel like you actually have insights, have understanding, have done, have the tools at your disposal, and have the assistance and support will help, women as well as all investors perform better, but also participate, more actively.
Lule, what about you?
Yeah, I think, part of it is representation. I remember we were about 20% women as well, and increasing each time, but 20% women. And part of it is representation. Like when you see people, and you're like, oh, they're in that as well, and that makes a difference. And then part of it is also what that representation comes a voice that brings in, okay, how do we access the ears of different kinds of people? So I'll give you an example. For the longest time in our industry, it's about women are risk averse. That is the statement that defines why they're not in investing, and I take issue with that. I am not risk averse. What I do is I take risk, I make it smaller, and I do it more frequently. So it's turning the language into the invitation of how people think about risk, right? The second is the practice before you start, right? So we have an award-winning investing platform, so you can actually do almost everything on our platform that you'd like without actually putting capital at risk. And that's another thing we know that appeals to women, is sort of like the practice before I start running and leaping. So I think one is representation. The other is that representation then leads to the design of the products and the language in a way that's going to be heard by those people. And I think that will change. It's important that it has to. There is no wealth building without people partaking in the markets. None. And so I think it is an imperative that we bring people in.
Yeah, more equal participation, definitely the key here. Victoria, what do you think?
Yeah, I just echo what's already been said by June and Lule about confidence. And also I think it's easy to make generalizations about men versus women and risk taking. We recently did a private investor survey which looked at the performance of all our customers on our platform over the last 3 years. And what was really interesting was actually women outperformed men across all time periods, not by a huge amount, but it was just interesting that across every period measured between 3 years all the way down to 1 month, women actually outperformed men. So this is something that we're trying to talk about as much as possible because trying to increase representation, like you said, and also just try to encourage more women to invest more because there's just no reason why the numbers can't sort of balance out within the years to come. And that's something that we're really, really targeting.
All right. I have many, many more questions, but unfortunately we have run out of time. So thank you so much to all of our panelists for some very insightful comments today. I do leave you with good news. It is now time for lunch. So please make your way out to just outside of the conference pyramid. Thank you very much.